So, how do you manage a risk that hasn't even happened yet? It's a problem we humans have been trying to solve for literally millennia. And the answer, these financial tools we use today, they have a history that's way older and frankly a lot more colorful than you might think. Let's dive right in. Our story doesn't start on Wall Street. Nope. It starts in ancient Greece, way back around 580 BC. Aristotle tells this amazing story about a philosopher, Thales, who used his knowledge of the stars to predict a massive olive harvest. Now, he didn't go out and buy a bunch of olives. Instead, he bought the right to use the olive presses for a low fixed price. So, when that bumper crop came in and every farmer was desperate for a press, demand skyrocketed. He sold his rights for a fortune. What he basically did was buy the first recorded call options, the right, but not the obligation, to get something at a set price. But believe it or not, we can go back even further than that. In the book of Genesis, around 1700 BC, Jacob agrees to work for 7 years, all in exchange for the right to marry Rachel. You could totally argue this was a type of forward contract, right? An agreement to do something at a future date where the price was 7 years of his labor. The point is, these ideas for managing what's to come are woven right into the fabric of human history. Okay, so what are we actually talking about here? A derivative at its core is just a contract whose value is derived from something else. That something else could be the future price of olives, the direction of interest rates, or the value of a stock. It's basically a bet on the future, but a bet that's been formalized into a contract. For most of history, these were pretty much informal agreements. But in the 19th century, everything changed. Derivatives really evolved to solve a very real, very physical problem that was absolutely crippling American farmers. I want you to picture this. You're a Midwestern farmer back in the 1800s. Every single fall, you and every other farmer bring your grain to Chicago. The market is just flooded and prices totally collapse. But then, fast forward to spring, supplies are low and prices are through the roof. This insane price volatility made it nearly impossible to run a stable business. The solution they came up with was just brilliant in its simplicity: the to-arrive contract. A farmer can now sell his grain in the spring for a fixed price he was happy with, but for delivery in the fall. This locked in his profit, and it transferred the risk of a price drop to a merchant or a speculator who was actually willing to take that bet. It was genius. It separated the physical grain from the risk of its price changing. This idea took off and quickly got formalized. The Chicago Board of Trade was set up in 1848 to standardize these contracts, and that was really the birth of modern exchanges. But the real game changer, that came in 1972. The market took this huge leap from trading futures on physical things you could touch, like corn and cattle, to trading futures on totally abstract ideas, like the value of a foreign currency. And, well, this created a whole new kind of challenge. I mean, how do you price the risk of something you can't even see or touch? How do you put a value on a bet on the future of an entire country's currency? The timing here was just perfect, or imperfect, depending on how you look at it. In 1971, the entire world financial system was turned on its head. The Bretton Woods system, which had pegged currencies to the US dollar, completely collapsed. And suddenly, exchange rates were just floating freely, creating these enormous new risks for any company doing business across borders. The demand for financial hedging tools absolutely exploded. But there was a massive problem. Even though you could feel the risk, nobody really knew how to systematically price it. How much should an option to buy German marks in, say, 3 months actually cost? What's the fair price? The answer came in 1973 from 2 guys named Fisher Black and Myron Scholes. They developed a mathematical model that, for the first time ever, gave people a rational, logical way to figure out an option's value. It was basically a formula for pricing risk itself. And this breakthrough completely transformed finance from, an art into a science. And it paved the way for the explosive growth of the derivatives market we know today. Now, what's really fascinating about how this model works is that it doesn't try to predict a single future price. Instead, and you can see it in this chart, it generates a probability distribution of all possible future prices. And by understanding the likelihood of every single outcome, you can calculate a fair price for that option today. It really did turn risk management from just a gut feeling into a real science. So, armed with this new math, the derivatives market just exploded in size and complexity. But this super fast, often unregulated innovation created a new and, frankly, a far more dangerous kind of risk. The problem child here was the over-the-counter, or OTC market. Think of these as private, custom derivative deals made between huge banks, completely away from any public exchange. And this created a hidden, tangled web of connections between all of them. So when one bank got into trouble, that risk could spread like wildfire through the entire system, which is exactly what happened in the 2008 financial crisis. The response was the 2010 Dodd-Frank Act, which basically aimed to tame this market by dragging it out of the shadows and into the light. The logic was pretty simple. First, force standardized trades through central clearinghouses. That way, if one firm fails, it doesn't take down the whole system. Second, require trading on transparent platforms so everyone can see the prices. And third, mandate that every single trade be reported to regulators so they can finally see where the hidden risks are building up. So you might be asking, did it work? Well, by 2014, a massive 76.5% of interest rate derivatives, and that's the biggest part of the market, were now centrally cleared. That drastically reduced that systemic risk we were talking about. And this visual just shows it perfectly. You can see the volume of cleared swaps, that's the orange line, just surged dramatically right after the mandates took effect in 2013. This was a fundamental rewiring of the market, all designed to make it safer.
And what about transparency? What about getting things out in the open? By mid-2015, over half, 55.7% of these trades had moved onto new regulated platforms.
You can see that shift so clearly on this chart. The orange line represents trades happening on these new transparent platforms. They're called Swap Execution Facilities, or SEFs. This shows a huge chunk of the market moving from those hidden backroom deals into a regulated, visible environment where everybody can see what's going on. So when you take a step back and look at this long history, a really clear pattern starts to emerge. These financial instruments, they're a powerful double-edged sword. On the one hand, they're absolutely essential tools for managing uncertainty. They enable growth and create efficient markets. But on the other hand, their complexity creates new, hidden risks that can threaten the entire system. The story of derivatives is really the story of us trying to harness their incredible power without getting consumed by it. So what's the big takeaway here? Well, first, derivatives aren't some modern invention. They're an ancient answer to the timeless problem of an uncertain future. Second, their evolution from physical grain to abstract interest rates shows this constant cycle. Innovation creates new tools, those tools create new risks, and then a crisis forces new regulation, starting the whole cycle all over again. We've gone from deals etched on clay tablets to contracts priced by complex algorithms in microseconds. And now, with AI and blockchain on the horizon, that cycle is definitely set to begin again. So the question is, what new tools will we invent next to try and control the future, and what new, unforeseen risks will they unleash?